Okay, so we're recording now. I'm going to share my screen here, and let's get it started. Okay, so today everyone can see my screen, right? We're good? Yeah?
Yes. Yeah.
Okay, great. Okay, so today we're going to talk about MCA funding. So MCA stands for Merchant Cash Advance. Okay, and I'm going to go over what this product is, how you can make money, who the product it's right for, and how it works. So I got in this business about 7-8 years ago, and I did not understand it at all. So it took me about a year to really grasp this, and I wish I would have had someone to kind of come in and tell me, hey, this is how this product works, this is how you sell it, this is who it's for. So I'm going to give you a little bit of knowledge so you don't make a lot of the same mistakes I made. So it like I said, it took me about a year of falling flat on my face before I finally figured this out. So hopefully that's not the same experience that you have. Okay, so what is a merchant cash advance? I will say this is a business product. So this is a product that's designed for people that have businesses. It's not, it is a form of gap funding because it can be used to bridge the gap. You can use it for payroll. People use it for inventory. There's all kinds of different uses for this. Working capital. It is a gap funding product, but it's not a product for someone that doesn't have a business. It's not a personal loan. So when you're offering this product, you're looking for people that have businesses. A merchant cash advance is an advance on future receivables. So what that receivables are sales. So a merchant cash advance company will come in, they'll give a business some money, and in return for some of their future sales, right? That's how they get paid. It is not a loan. And I'm going to talk more about this as we go into the slides. This is kind of a general overview, but just understand that this is not a loan product, which might be confusing because you're thinking, well, if they're giving me money and I'm paying it back, how is that not a loan? And you're not really going to hear the word loan too much when I'm talking. We'll say things like funding or advance and not use the word loan. And I'm going to explain why this product isn't a loan and what the differences are. And then it's not credit driven. So this is a good product for people who don't have great credit. I mean, obviously we can work with people that have good credit, but this is usually for people that need money fast. Maybe they don't have great credit, but they have sales, right? They have a business and they have sales coming in, but they need some money. It's good for that because it's not based on personal credit. You got a lot of business owners that maybe they don't have great credit, but they've struck gold in some business and they've got money coming in, but they need to get to the next level. So this is a good product for businesses like that. I would say most of the time this isn't going to interest people that have 800 credit scores and that would qualify for lines of credit and things like that have really established businesses that have great cash flow, because those customers typically are not going to go for this product. They're not going to like the pricing of it, and we're going to get into pricing here in a minute. However, sometimes I do get customers or merchants that they have great credit, they have good receivables, good sales, but maybe timing is the essence. They need money right now. They can't wait for SBA. So this could be a good bridge for people that are going to go to SBA, but they don't have time to wait 2-3 months for the SBA to get back to them. So, and we'll talk about that a little bit more. So the way that an MCA is priced is based on a factor rate. I'm not going to get too much into this on this slide, but I put this here because with a traditional loan you have an APR, and a lot of your customers are going to think about loans. They're going to think about, well, what's the interest rate, what's the APR, and an MCA product doesn't have an APR. It's a simple factor rate. And we're going to talk about that a little bit more. This is kind of a breakdown on how the MCA works. Weekly or daily payments. So a merchant cash advance are taken from their payments are taken back from the merchant to repay the advance either on a weekly basis or a daily basis, not a monthly basis. So, and I've thought about this a lot. I think part of the reason this product doesn't have a monthly payment is because it's not a loan, but also the risk is much less for the lender if they can understand the health of the business based on a shorter term, right? So if you've got a product or if you've got a loan and you have a 30-day payment, so a payment comes out on the 1st of every month. So if your payment comes out on the 1st and then there's trouble, right? The business has a major slowdown, a shutdown, something happens to the business that decreases the sales, the lender's not going to know about that for 30 days. Whereas if it's a weekly or a daily payment, they're going to know almost instantaneous. And we're going to talk about how the lender takes the payments and how they base this. So, and how it's split up over daily payments. Part of the other reason why it might be daily or weekly is there's small payments that are coming out. You know, if you take a monthly payment, a large monthly payment, and you split it up into really small daily payments, it's going to be easier for the merchant to digest. You know, if you own a business or you know someone that owns a business, small businesses tend to operate on cash flow. So as long as they've got cash flow coming in, this is designed to minimize hurt to the cash flow and still allow the lender to get paid back. So that's why they're broken up into weekly or daily payments. And it's typically automatically debited from the merchant via ACH, so electronic check. So every day, Monday through Friday. So just on the weekdays, that payment's coming out, or maybe they compound it into a weekly payment, which is just basically taking the five daily payments and combining them and putting them on one day of the week every week. The going back to the weekly and daily payments, the lender will determine if it's going to be a daily or weekly payment based on the risk of the file and also the amount of money they're lending out. So typically on larger amounts, $100,000, let's say, maybe even $50,000 might be a weekly payment. If it's a high risk file, and believe me, they do a lot of high risk deals. This is a great product for people in high risk industries that don't have great credit. They can't get funding from a bank and they need money immediately. It might be a daily payment on those higher risk products. And then renewals. Renewals mean that, coming back and getting more money. So typically once you're paid down on the advance, 55 to 65%, lender's going to come back and they're going to say, hey, do you want more money, right? We talked about cash flow. The goal of the lender is to keep the merchant continually making the daily payment or weekly payment forever, right? That's how they make money. And because businesses operate on cash flow, you can imagine, if a merchant gets a $25,000 loan, they're paying on it, they get to around the halfway mark, lender comes back and says, hey, do you need more money? Most likely the merchant's going to say yes. We're seeing that most merchants on this kind of product are renewing 3 and 4 times. Some more, some less. But this is good for you because we're going to talk about how you get paid. Every time that the merchant renews, you get paid again. So the idea here is to build a book, right? You're building a book. You might have smaller loans, or you're not, because it's based on a percentage, and we're going to talk about the pay and the percentages here at the end of the slide. But if you get 30 or 40 of these businesses and they're renewing, you're getting paid all the time. So, and most small businesses need money. So this is an example, and I'm going to talk a little bit about this industry on this slide as well. So here we've got Alex. He's got a pie shop, right? We're just using it as an example. And he gets a $15,000 MCA cash advance. So the lender deposits $15,000 into the business account, and then Alex goes about his business, right? And maybe he's using it to make payroll or advertising or to buy, more product or whatever he needs to use it for. And then he deposits or he processes his credit cards and his debit card payments from his customers. And in this scenario, the merchant cash advance company, they take a fixed percentage of his credit and debit cards until he reaches $20,000, because that's what they determined the price of taking this advance out was. So this is an important part to pause and help you understand this industry a little bit better. So when this product came around, it's been about 20-25 years. And now this is before you had companies like Square. You may be familiar, this might be familiar to you if you've ever taken out a Square loan on your merchant processor or a PayPal. I think Amazon does the product as well. Hold on, I'm gonna let some people into the room real quick that are joining a little bit late. Hey, welcome to everyone that just joined. So sorry if I didn't get to you right away. So you may be familiar with this kind of product. Well, years ago, when this got started, someone got the idea like, hey, what if we were able to do a product that wasn't a loan? We would have the merchant switch their credit card processor. The lender would have them switch their credit card processor to the lender, and then we would just take out a percentage of their daily or weekly sales based on a set percentage until we got paid back. Now that's not a loan, because if sales go down, then you don't pay as much money. If there's a break in business, you don't pay anything because it's based on your future receivables. But what was happening, some customers, some merchants didn't want to change their processor. That's a headache, it's a hassle. I'm not changing my processor. I already like my processor. I have good rates. I'm not going to do that. Or what if they're a cash-based business? What if they don't process credit cards? Or what if they're a restaurant, so they take a lot of cash and some credit cards? Or a medical product that gets tons of money through insurance and maybe a little bit or none through credit card. So obviously this product, the way that we're showing this here, wouldn't work. This wouldn't work. So someone got the idea of saying, hey, if we still do something similar where we give them some money, right? And it's not a loan, we're going to process a specified amount of money based on a term until they pay it back. They don't have to switch out their processor, because we can just come up with a term. We could say the term's a year long, right? And I'm going to show you the math on how that breaks down on pretty much what every company's doing right now. Where this started out was something called a credit card split. And that's what this example is here. This has evolved into a specified daily or weekly amount that, as long as business stays the same, if they pay it within that term, they'll pay back the total amount. So let's look at some simple math here. It's very easy to calculate an MCA. And I'm just going to pause here. This is a really important part of this product. When I started trying to sell this product, I didn't understand the costs and how this breaks down. And this was a hard part of me to pitch this. If you're like me, I struggle with this part of it, not the math per se, but just understanding it, because on the surface, this looks like a loan product. So I was selling it like that. So factor rates, we talked about that earlier. This is how MCAs are priced. So factor rates generally are from a 1.1 to a 1.5, 1.1 being low, obviously, and 1.5 being higher. The lower the factor rate, the cheaper the money is. All right, and it's easy to calculate the factor rate because it's very simple interest, not an APR. So if we have a $5,000 advance and we've got a factor rate of 1.3, You take 5,000, you multiply it by 1.3, $6,500. Some of you can see this too. This is 30% interest, right? So the 3 right here, if you drop everything before the decimal, this is 30% simple interest. That's another way to look at it. If it's a 1.2, it's 20% interest. If it's a 1.25, it's 25% interest. Simple interest, not an APR, because there's technically no term. So how we can't calculate an APR on this product because there's no annual term. So when this product evolved into something that you didn't have to switch your credit card, it was impossible to reconciliate what a merchant was doing every day. Because if you don't switch your merchant processor, or if you don't process credit cards, how do you know from a lender's standpoint how much they're depositing? So they averaged it out. So in this example, the 60 here, you see the 60 right here, this is 60 days, right? And we said Monday through Friday, so this is around 3 months. On average, you're looking at 20 to 21 debits per month. So this is, let's say, 3 months. So if you take 6,500, you divide it by 60, that's $108.33 daily, or $540 weekly. If you add this up, if you were to take 540, you know, and add this up, you would get around $6,500 over the period of 3 months, or take 108.33 and multiply it by 60. You're going to get around that number. But you might be saying, well, if this is a product that's not a loan, what happens if business slows down? Because we're not changing the credit card processor anymore. So the way that it works is there's still a specified percentage. Let's say they're taking 7%. They're still going to take their daily payment or weekly payment. They're gonna basically determine what that would be. If business slows down and they take more than the specified percentage, then they can reconciliate, meaning the merchant can go back to the lender at the end of the month and say, hey, we had a slow month, and they could potentially get a refund. Hey Mo, you're unmuted. Let me mute him. I really don't understand what I'm doing. Okay, there we go. And I'm going to show you what a contract looks like. This is a real contract from a merchant. So you can see here, purchase price, $100,000. So this merchant got $100,000 advance. Okay, the purchase percentage, 7.28%. So they're going to take 7.28% of their monthly receivables until they get to $131,000. So looking at this, you can see there's a few things missing on this contract. There's no factor rate here. They're not showing the factor rate, and they're not showing the term. The reason for this is because technically there isn't a term, because if they make their weekly payment, and I'm going to show you the math on this, until $131,000 is paid down, you're going to see how long that's going to take when we do the math on it. But if business slows down, it could stretch the term out, right? Because let's say business slows down in half, and now that weekly amount goes down in half, that's going to stretch out the term and the time to pay. So the merchant or the lender is basically looking to get $131,000 for the $100,000 that they gave out. So they're buying their future receivables at a discount. So does anyone know, there's a question, does anyone know, looking at these numbers, what the factor rate would be here without seeing it? 100,000 to pay back 131. Remember, factor rates are 1.1 to 1.5. Anyone? All right, the factor rate's a 1.3, right? Because 31% interest, 131,000. So let me show you the math on how you would figure this out, since I know that math is very fun and interesting. So $100,000, right? We're going to multiply by the factor rate of 1.31, which gets us 131,000. So that's how we know it's a 131. Okay. Now, if you divide, we're going to try to figure out how long is it going to take this merchant to pay back this advance. So if you divide the payment, the weekly amount, $2,112.91, right? That's going to be 61.99 forever. So basically almost 62 weeks, right? And so we're just going to say, for argument's sake, 61 weeks, right? There's 4 weeks in a month. So about 15 months, right? So it's going to take, if you make a weekly payment of $2,112.91, it's going to take you about 15 months, a little bit over 15 months to get to 131,000. So that's how you can calculate this. You can also see on this, there's some other information. They're talking about what happens if it's on a holiday, and there's some fees. The merchant's taking a 3,000 or 3% processing fee. So the 97,000 is what the lender's taking. That 97,000 is what the merchant's going to net. And then wire transfer fee and insufficient funds fee. Hopefully they don't get that, because that means that they don't have enough money in the bank to cover the advance. Of course, at that point, if they didn't, there could be a reconciliation. You know, maybe there's a slowdown in business to the point where they can't take their payment. So the nice thing about these kind of loans is that they're unsecured. So if there's a legitimate slowdown in business, that's it. That's just the risk that the lender takes. Any questions on this part? This is kind of the boring math part. And I saw Jill said that she was going to guess that, and Alicia said that she was right. So yeah, don't be afraid to yell them out. That's great. So here's the pros and the cons. Right, I like to give the whole story here, not just all the positives. Fast approval, right? This is a pro. We can fund a business same day, right? This is unheard of. You could go to a bank, they're going to ask you for all kinds of documentation. You need money today or tomorrow, and you have receivables. You have regardless of credit, we get money in your bank account, depending on the time of the day, of course, the same day or the next day. Very quick. Obviously, higher amounts might take a couple days, but even on large approvals, I've seen $500,000 approvals be from the start to the finish, go into someone's account in less than a week. I've personally funded a deal for $125,000 in 3 hours from start to finish. So that's great. Flexible repayment, we talked about it. If something changes in the business, the repayment's flexible, the term's flexible. The requirements, I'll go into detail about typically what's required we call the recipe, what they're going to need in order to qualify and get approved. It's very, very few requirements. Bank statements, driver's license, voided check, maybe proof of ownership or something like that. But you're not going down there with a business plan, right? You're not going down there with years and years of tax returns and P&Ls. Of course, on some of the bigger deals, that might be required, but it's going to be far less than what a bank product like SBA or even a line of credit would be asking. So the cons, you can see it's expensive. In that last example, that's 31% interest, basically, simple interest. That is not cheap, but there's a price to pay for people that need fast money, right? Let me close out this calculator. Or they don't have very good credit, and they need the money quick. It can hurt your cash flow, right? Now, I personally think that it's good for cash flow when it's broken up like that. You don't have a giant monthly payment coming out every month, but you could see how a daily payment coming out every day might affect your cash flow. And this isn't a regulated product, right? What does that mean? It's not a loan, so it doesn't fall under the same guidelines. Like if you were to charge 31% on a $100,000 business loan, that would be illegal. They're criminal usury, actually. So because this is not a loan, they don't have to follow those guidelines. Now, I will say that there has been a push recently to try to regulate this industry. So you're starting to see states with disclosure laws that protect consumers. So that's been good. I personally welcome those kind of things because you want to make sure that you have long-term relationships with your merchants and that you're not doing anything shady. This product, you don't have to hide anything with this product. Just you have to know who this product is for, right? And so you should know already that if you have a customer that's got great credit, they've got an established business, they've got great receivables, and they're very concerned about interest rate and asking you what the APR is up front, and they have time and they don't need the money right tomorrow, that you're probably not going to be pushing this product. You're going to go into a bank product like line of credit or the Nina product that we discussed a couple of weeks ago. And just knowing that is going to help you save time. We had the meeting last week on qualifying. This is the important part. You don't want to waste your time, get all the way to the end of the line, and they look at the daily payment or the weekly payment, and they're like, "This is insane. This is 31%." And they're upset. You're upset. So just be aware of how this product is and who it's for. I'm going to pause here too. So the information that's going to come up on this slide, this is very general. I would tell you that it's very hard for me not to get someone approved for this product. I'm probably maybe 90%. 90% of people that come to me that have a business are getting approved for something in this product. And I'll tell you some reasons why there might be declines, but I would say if you're on the fence or you don't know, versus just going off of these guidelines, I would ask for you to email me. I'm going to put an email in the chat here at the end, and send me over a couple months, 3 months of business bank statements from your merchant, and I'll tell you. Typically, what would affect approvals and things like that are really the amount that the merchant's looking for. So if they have receivables, but those receivables are not a lot, they're not going to get approved for $150,000. So that would be the one thing that I would say. So something we could get them approved for, but they may not like it because it might not be how much they want, right? So items needed for pre-approval. We need a completed application. We'll send that out via Adobe Sign so they can fill it out on the computer. It's really easy to do. We need 3 months of the most recent bank statements. These are going to be business bank statements. That's important. And a clear copy of the driver's license. And we should be able to get them a pre-approval within hours usually. Underwriting guidelines, again, take this with a grain of salt. Some of this are deal killers though. They have to have a business bank account. So if you've got a merchant they're running a sole proprietorship and they just went down to the bank and opened a personal account, or they just used their personal account to run their business through, we can't fund them. They have to have a business bank account. You won't see it with LLCs and Incs because they would have to open it with that, and I guess unless they're using a personal account. We're looking for a minimum of $10,000 in monthly deposits. This doesn't mean profit. They don't have to be profitable. They just have to be depositing $10,000 or more in monthly deposits. Usually we're funding around 100% of this. So if you bring me a merchant and they have only $10,000 a month in monthly deposits, I'm not going to get them $100,000. I get them around $10,000, and they might say, "Well, I need $100,000." Well, then we'll have to either go with a different product if they qualify, or we'll have to, kind of field their expectations, right? 550 plus FICO. This is a recommended guideline. This might seem low. If you're familiar with some of our other products where we're asking for 680, you might say, wow, 550. I'll say that I've funded merchants with less FICO than this. I've funded merchants without even running their credit. We have products that in this category where as long as they're out of bankruptcy yesterday, I could fund them today. Seriously. So you can see this is really revenue based. This isn't credit based. Now, I will say again, if you're looking for high amounts, having good credit is going to be important. I'm not going to be able to fund you for $200,000 if you've got a FICO score that's really low and you've only got $10,000 worth of deposits and things like that. So I have funded merchants with 550 or even lower credit scores that had really good receivables, but it's usually they got to have one or the other. Can't be both really low. Looking for companies that have been in business for at least 12 months. We can do as little as 3 months, but again, depending on how much they need, right? So stipulations for funding: driver's license, voided check, proof of ownership. Typically that's going to be a tax return, maybe an EIN letter, or if they're in a state where the Secretary of State shows the members. Not every state does. Like Marcus, he's out of Delaware or New York. We can't really determine proof of ownership in those states, right? New Mexico, but places like Illinois, you can look right on the Secretary of State and see who the members are. So that would be considered proof of ownership. And then a bank verification. This is going to be typically a link, decision logic, or plaid that's sent out to the merchant at the final part of the process. The merchant will log into their bank account and it'll send the lender a read-only copy of their bank transcript. This is for a couple reasons. One, to determine if the bank statements that were sent were real and not something edited or something like that. Also to determine they haven't taken out another loan, right? Stacking on this kind of program, because you're buying their future receivables, is a no-no. They don't want you to stack them because they're buying your future sales. They don't want you to sell those receivables multiple times, right? So if you have a merchant that's only got $10,000 in monthly deposits, they need 50,000, and we take them out to 5 different lenders and get them 50,000. They can't make their payment because it's 5 times what it should be. So they want to make sure that you're not stacking. And then also for reconciliation purposes, right? If the lender can look and see that you've had a slowdown in business by being able to see a lot of these services like Plaid and Decision Logic allow them to link the account, and there's no risk of them getting into your bank account. You don't have to give them your username and password. They can see if you've had a slowdown in business and refund you, that kind of thing. So reasons for decline, right? Who's getting declined? Not a lot of merchants get declined, but there are some ones here. So previous MCA default. If they've already had this product from another company and they didn't pay it, you're probably not going to get them one from another company. Now, I have companies that will fund defaults as long as they were paid back or a payment plan was made. Criminal history. This one might seem like a crazy one, but I've had merchants that have been declined because they had criminal history, even 10, 15 years in the past, especially finance crimes, fraud, something like that, right? Some restricted industries. I could pretty much find a product for almost any industry, but ones that are really hard to fund. Cannabis is difficult. I have companies that do cannabis funding. The adult entertainment industry, very difficult to fund for obvious reasons. Pawn shops, things like that. And then your normal ones. Transportation, difficult to fund. trucking, transportation, financial services. I guess ironically, lenders don't want to fund themselves, so that's difficult. A recent bankruptcy. Like I said before, I do have lenders that will fund on a recent bankruptcy, but they might be limited at $50,000 in funding, right? And then fraud. I say fraud separate from criminal history because fraud comes up during the bank verification process, right? If they find out that the banks were edited, and there's a lot of fraud in this industry because it's not a bank product and it's fast. So that would be another reason why they would decline you. Let me see here. All right, so these are some guidelines. Loan amounts from $2,000 to $3 million. No down payments. There's not a fee that's charged to get them pre-approval. Term lengths usually short, 3 to 24 months. I would say most of the terms are falling in that like 8 to 12 month range. Higher amounts typically have longer terms. One thing to note too is usually if you take a less term, the merchant takes less term, then the factor rate will go down, meaning that the cost of the money is cheaper. Daily or weekly payments, no collateral required. These are unsecured loans. So you don't have to put up your house or anything like that. Funding times, 24 to 48 hours, very quick. Documents needed. This slide says 3 to 6 months. The other slide said 3 months. I'd say on average, it's almost always 3 months. Sometimes it's a little bit more if the industry is kind of crazy, or if you live in New York or California, one of the new regulations is that they have to get 4 months. These are the new California and New York laws. So might be 4 months, might be 3. If you send me, when I put the email, if you have a merchant and you think that's going to be right for this product, if you get the bank statements for me, 3 months, I'll be able to tell you within 5 minutes of looking at them how much money this person's going to be able to get, and if we're going to have problems. I will say, I'm going to go back to this slide too real quick. Another reason for decline, and that's in the underwriting guidelines, are negative days. I didn't put that on the slide. So meaning if you've got if we've got a lot of negative days, meaning non-sufficient funds, days where it was negative money in the account, meaning that the lender, if they were to give you a loan, would be unable to take their payment. If there's more than like 4 or 5 negative days or a bunch in a row, that could be a reason to decline or put you into a very, very high risk MCA company that maybe wouldn't be what the merchant's looking for, right? Lower amounts, things like that. So keep that in mind too, right? It's not just the monthly deposits. You don't have to be profitable, but you got to have some money in your bank at the end of every day when you're looking at the daily balances in order for the lender to take their payment. You can imagine if they look at a company that has $25,000 worth of deposits, but they're negative almost every day, the lender's going to say, well, if they had a loan with us right now, they would have missed their payment 10 days in a row. That's not going to be fundable. So keep that in mind. Again, I'm happy to look at any bank statements you send me over to determine if you've got a prospect here. Fees. What are we charging? So on this product, you've seen some of the other products that are 15-20%. This is a 5% product. So we're going to charge the merchant 5% in order to get them funded with this product. So on a $100,000 loan, they would pay us $5,000 after the funding, right? We don't take any upfront fees. We already discussed that. So what are you getting paid, right? This is important. So the 5%, you guys are getting 4%. So we're going to take 1% for the back office, the Sequoia G2 back office. you're getting majority of the money. So on $100,000 funding for a merchant you send us, you're getting $4,000 commission. So, and here's the great news. When they renew, you're getting a 4% commission. And so when the time comes, the lender reaches out, or I reach out to you and say, hey, it's time for renewal. They take more money, you're getting 4% again. 5 months go by, they take more money, you're getting 4% again. So this is a huge way to make money. This is a great product. And I would say that most people are renewing 3-4 times. So, you know, we've got people that are getting checks every 3 months for $5,000-$6,000, and as they build their books, it's just coming in like clockwork, right? Because most of these companies rely on cash flow. So hopefully that's a really good incentive. And then we'll just recap here. So again, merchant cash advance, not a loan, right? The lender gives the business some upfront money to purchase their future sales. The business repays it plus fees, right? So who is it for? Businesses that need fast money, right? They cover their cash flow expenses, payroll, inventory, whatever they need. And then how are they repaid? So they can either be repaid daily automatic based on their credit card sales. Again, that's on the left-hand side. I'm not seeing that really happening. This has evolved into a daily or weekly withdrawal, and they're determining, what that amount is based on, their past performance, right? The reason they're looking at those 3 months of bank statements is they want to see, okay, if this is what you were doing in the past, this is what you're going to be doing in the future. We're going to assume that, and so this is basically going to be something that you can afford. One thing that's important here is lenders aren't going to set you up or set your merchants up to fail. They want you to be able to pay it back. So they're going to look at those daily balances, and they're going to come up with a number that you can afford, or your merchants can afford to pay back. And that's important, right? No one wants anyone to fail. Rates and fees. Again, they're based on factor rates. Very simple interest, right? 1.1 to 1.5 typically. It could be a little lower, could be a little bit higher. And it's very easy to figure out the cost, right? So you're going to multiply by the factor rate. So, there's an example here, $100,000. The payment amount is $666 per day, and it's a 10-month term to pay back $140,000. You can see this one's a little bit more expensive, right? The example that I gave you was a 131. Here we go. This is your second chance. So $100,000 to pay back 140. Who knows the factor rate? If you can put it in the chat if you don't want to yell it out.
1.4.
Yeah, exactly. It's a 1.4. Yep. And I would say that's on the high side. 1.4 is on the higher side. So in this example, this might be a high risk business or something like that. And then pros and cons. Quick approval, easy to get approved, right? Not a lot of documentation, no collateral. Most of them don't even have personal guarantees. There are some that do. Of course, if you're a sole proprietor, that's pretty much personally guaranteeing it anyway. And a repayment's based on fixed percentage of your sales. Cons, expensive. Paperwork can be challenging to understand, right? So we did like a bunch of math there. You don't have to break down that math to every one of your customers. And I don't even recommend it. So if you're like, I don't all that math, I don't want to do all that with every customer. I just want you to understand the math so you know what you're providing. And we can, if you have questions about the math, email me, or we can get on a call. I can do more breakdowns for you, to kind of figure out all of that. It's just easier to understand if you understand how these merchants are being charged, so that way you can sell the product properly. My biggest hurdle was that. Frequent repayment schedule. So it's not a monthly payment. That can be a con. debt cycle risk, right? We talk about renewals. They get to the end or they get to the middle of their loan, they need more money. And the lender understands this too. You know, they understand that they could be taking some of the money from the loan that they just got and making the daily payment until they're profitable. You know, especially on customers, you get customers that do a lot of importing, right? They might have a container that's on the water. They need to get it out of the port. It's going to cost them $30,000. They've already got the product sold, but they need the money first to pay for the product in order to sell it. So they take out one of these loans, they get their product out of the port, but then there's a 2-week lead time, or there's you know, they have terms. They're net 30 before Costco pays them for their order or whatever. So there could be a little bit of a debt cycle here in terms of that, and not regulated by the government. So you know, no one's getting ripped off. These are all real companies, but you know, they don't have the same kind of disclosures and APRs and things like that might you know, be protecting your merchants a little bit more. Although that, like I said, that is getting better. And then lastly, you know, you get 4%, which you know, we really like the idea of taking only 5% and giving the majority of it to you, since these are your customers, and then the back office gets 1% to process. And that is my last slide. So, and we're at about 46 minutes. So questions, if you got a question, I'll give you $1.50 to ask it. You know, so let me know if you have questions, anyone. Yeah, I think we're good. Mo, you still there? I don't know if he's here or not. He might have bounced off. Let me, since there's no questions, or if you think of one, yell it out. I do want to say one thing as a side note. Some of you have been getting some leads from us. If you're on our team, we've been handing out leads. We've got a new product that we're going to introduce. It's not even really a product. It's going to be kind of a business in a box. I'm going to share a little bit of that. We're going to do a presentation, I believe in 2 weeks. So there's going to be an announcement that's going to go out. You're definitely going to want to be on that call. This is going to be basically a business in a box, pretty much, right? We've given you these tools. You know, like today I gave you a tool, it's a product, and then you need to connect that with the customer. And that's what we're going to be doing with this product. So we've started to hand out leads to people, just really as a testing ground for this new product. So some of you got leads. If you didn't get leads, you know, reach out to us if you're on our team, which is another thing I want to say. If you're not on our team, you should be on our team. So I told Mo that I was going to deliver this message, you know, so he wouldn't have to, which is, you know, if you want to join a team, we're doing a lot of big things. You can go to your back office, you can go to IT, call IT or email and get switched over onto our team. We would love to have you. We're doing a lot of one-on-ones. We do this Friday night huddle up every Friday night. A lot of familiar faces. So you know, I think we're making a lot of big moves. So we have a really great schedule over the next 4 or 5 weeks. Next week, Mo's doing the empowerment training, you know, on mindset. The week after that, we're going to do the business in a box lead kind of generating machine. A gentleman named Albert's going to be on that call. He's an expert and going to be our marketing guy. This is where we're getting the leads that we've been giving out now. We're going to go back in and do another presentation on the FICA, the wellness program on workers' comp. We're going to do a refresh on that. So if you missed that, and then I'm trying to think what's after that. Then a couple more empowerment trainings. We're doing one on ethics and, you know, not over promising, under delivering, that kind of thing. So yeah, so busy busy 4 weeks every Friday. Someone's got a question, Jill. When determining the repayment amount, is the average revenue calculated over a certain period of time, or is it reevaluated periodically since it tends to fluctuate a lot? Yeah, so good question. The lender will average out, right? And so for the most part, I don't see a lot of reconciliating happening. So we'll talk about what that looks like. So let's say that you have a merchant, they took out an advance, and they got $100,000, and we'll use that example that we had earlier, where it was $100,000 to pay back $131,000. And I have the numbers here. So in that example, they were paying $2,112.91 a week for 61 weeks, which is basically a little bit over 15 months. On average, that's what they're going to continue to pay. If there was a dip in business, then the merchant at the end of the month has the ability to reconciliate. This is really the biggest thing that makes this not a loan. If they were unable to reconciliate, then it might be considered a loan, because it's a weekly payment, and there's technically a term, even though it doesn't say it on the contract. It is a little bit over 15 months. But if there was a dip in business at the end of the month, in this scenario, I think it was 7.28%, right? It said the specified percent amount on the contract. If the lender took more than 7.28% for that month because there was a major dip in the business, then they would be owed a refund at the end of the month. This might seem like a convoluted process, because you're like, well, who is going to calculate all this? And I think in a lot of ways, this product was better and worked better when you were able to take a piece of it from their credit card sales, but it's not practical. So this is the way they have to do it. Now, recently, there is a lender that you link your bank account with the lender. It's only read only, so they don't have access to your account, and they reconciliate for you. So at the end of the month, they'll automatically refund you if you're over the percentage that they said they were going to take. I believe that's where this industry is going. I think that regulations are going to come in, they already are, that are going to say, hey, you have to automatically be able to reconciliate in order for this not to be considered a loan. I think that's what's going to happen long term. Right now, there's only a couple lenders that do that. Everything else is a manual process where you have to go in, the merchant has to go in and say, hey, I had a major slowdown in business, and you guys took, 7% of my receivables, but I didn't even process that much, and you owe me a refund. And they will reconciliate that way. So there's definitely not the most convenient way. 99% of the time, merchants don't reconciliate. They pay their weekly, and the lender factors it in that they can afford this weekly or daily payment without hurting them, based on based on the receivables. Any other questions? I think that was it. Mo, you back?
I'm here, guys.
Yeah. So we had a good one. It was a little bit of math, but I think this is a good product, and definitely a lot of money to be made here for the reps.
Absolutely.
And I did tell everyone at threat of death that they have to join our team. So I think he bounced off right when I said that. So good enough. So he I think he looks like he's in a hotel or something, visiting some family. Okay, well, I'm gonna leave it here. If anyone has any other questions, I can stick around, but we're gonna cut it. Well, it's not short. It's been about exactly an hour, so we'll keep it at that. And let me put my email in the chat, and you can take this down. Put it in your contacts or, so if you want to email me, not just about this, but any product or that we've mentioned on these calls, or if you want to join on the best team in Sequoia, let us know. Let me know.
Jill.
Yes, Damon.
Yeah, yeah. Is this product better than gap funding?
I would say that this is a form of gap funding, right? So we've got two products in gap funding. So one product is gap funding on the personal side, which is maybe what you're familiar with, and that's using things like their pay stubs or W-2s. That tends to fall into people that maybe don't have businesses. We can do gap funding on the personal side, and we can do MCA funding on the business side. So really, this is kind of a form of gap funding for businesses, specifically.
Hey, Jay, I'm sorry, my phone went out. But I just wanted to add to your training. Good job. I peeked my head in there a few times. Good job on the training. I just want to let everybody know that, this particular product that G was speaking of, we've actually been working that product for about 7 or 8 years, correct?
Yep.
And we've made a lot of money from that product alone.
Yes.
From that product alone, okay, guys. So this is definitely something that a lot of companies are wanting to use because of its flexibility and being able to get it. Okay, so definitely don't be afraid to sell it. Don't be afraid to present it. It's definitely a solution to those that it's a solution for. It may not be a solution for everyone, but the people that it is a solution for, utilize it. Okay.
Yeah, go ahead, Mo. Sorry.
No, it's just an extra nugget that we have under our belt, okay, to utilize, okay, with all the other different products that we have. Go ahead. What I think Benny had something.
No, I didn't have nothing, Mo. I didn't have nothing.
Oh, go ahead.
No, I was just saying. I mean, if this 4% should excite you, because I'm not even ashamed to say it. I've made most of my money in the last few years on this specific product. So, we have a lot of different products. So, it's important to diversify, and we do, but a very large chunk of the money that I bring in is from this product because it's easy to fund. This is a very easy product. So you get people, they need money. The businesses need money right now. They need it tomorrow. They come to you. It's an emergency. I got to have my money tomorrow. I got to make payroll. We look at a couple bank statements, get them a contract, and they're funded within the same day or the next day, and they have the money in their account the very next day. So, and then you get paid. You get paid right away. So it's great.
Gerald.
Yes.
Gerald. Hey, but this product is based upon accounts receivable. They got to have some sort of receivable accounts coming in for their business. Am I correct?
Yeah, exactly. It's based on their receivables. We don't usually look at AR reports unless it's a big loan. So they'll determine the accounts receivable based on those 3 months of bank statements. So we need to see at least $10,000 worth of deposits going into the bank account every month, right? So it's not going to work for companies that are brand new startups, right? That's going to be a line of credit product or business credit card product. We have a product for startups. This is going to be for a somewhat established business. They've been in business for a year and they've got some receivables.
Okay, let me ask you this question, Gerald. I got a lady that owns a healthcare business. That wouldn't qualify. That wouldn't qualify, right?
A healthcare business is great. I love healthcare. Absolutely would qualify. Yes.
Well, Mo, that would qualify, Mo.
For what customer?
The customer.
Yeah. Yeah. You can go that product. Absolutely.
Yeah. Healthcare industry is wonderful. It's actually one of my top industries. I love that product. I love that company.
If she can show the income, she can go that. Yeah, she definitely could do that.
Yeah, because she bring in about $40,000 a month off her business.
No problem. I fund that all day long.
Well, Gerald, how do we get in contact with you?
I put my email in the chat. Of course, you can go through. You can get a hold of me through Mo. Mo's my partner. Anything that involves this product specifically is going to go through me. So I process all these files. This is my bread and butter. So either email me, Mo. Are you on our team?
Yeah. I just
Yeah, he's
joined.
on our team.
Mo twist my arm.
Yeah, Mo, you missed it, buddy. But I told everyone at threat of death to join our team. But I waited until you weren't on the call to say it. But that's what happened.
Listen, listen. We've got a lot of exciting stuff that's happening for our team right now. And those of you all that's been receiving those leads that we've been giving out to you, those are just kind of like a teaser as to what we're about to do with the team. We're going to have a whole lot of leads. Real estate stuff is going to be exclusive to us, okay? So, the stuff that we're dumping money to generate so our team can increase their revenues. Now, these not be going out to everybody. It's going to go out to the people that's joining our calls and people that's being trained on these calls, okay? If you're participating in these calls and you're learning how to deal with these customers, we will give you those leads. So that's exciting. That's exciting. We're also working on some incentive programs, some trips. We're going to be doing a company vehicle for our top performers, things like that. So people that's going to be performing at their top tier, we're going to have all type of things that we're rolling out for you really soon. So let's make sure that we take these opportunities that we have seriously, that we're rolling out. We just rolled out that 100% funding program. So I've been getting calls about that lately. Okay. So, I mean, a lot of things are great things are happening. It's what G just taught you guys. So listen, just stay plugged into the team. Stay plugged in. Keep doing what you're doing. Benny, just keep doing what you're doing, bro. Okay.
Yes, sir. Yes, sir.
Benny, if you send me over, Benny, if you send me over the 3 months of bank statements for your healthcare merchant, I will review them and I will get back to you. If you send them over to me this weekend, I'll get back to you on Monday. If you send them over next week, I'll get back to you same day. So, and I can tell you exactly, how we can help. But on the surface, absolutely.
Okay, and Mo, we still gonna work with our credit and everything, so we still gonna do that. Okay,
Yep.
not a problem. Hey, I like
Someone
that.
else had a question. I heard. I'm sorry, I didn't see who it was.
It's
That was
Alicia. I didn't.
Hey, Alicia.
Good evening, everyone. I just wanted to thank Gerald for this call. I really enjoyed this call, and I appreciate everything that you all are doing. Like, I'm really excited. I appreciate
Thanks,
it.
Alicia.
You're
Appreciate
welcome.
the kind words. Thank you. I'm glad you enjoyed it.
Wait, Alicia, you just made a lot of money today, right?
Huh?
You just made a lot of money today, right?
No.
Well, you did.
Well, wait a minute. Hold on. I don't know anything about that.
So we got approval for one of your deals for a lot of money. Okay.
Oh, really?
And,
I'm sorry. I got to take my glasses off. My allergies acting up.
Yeah.
No,
So
we-
we're gonna talk to you about that.
Yeah, we got a bunch of pre-approvals on your guy. So we haven't we haven't shared that with you, but you made some good money today. So,
Okay. Thank you. That's such a blessing. I really appreciate it. Hard
No
work.
problem.
Wake up in the middle of the night. Thank you, everyone.
Congratulations to you. Congratulations to you.
Yeah.
That's
Appreciate
a nice payday for you. Nice payday.
Yes.
Congratulations, Alicia. Congratulations.
Oh, thank you, Marcus. Thank you, everyone. I appreciate that. I don't mind sharing what I did. I'm very humble. So, I went on LinkedIn, I believe. Did I go on LinkedIn? I believe so, but I wake up in the middle of the night for like at 4, 3 o'clock in the morning. First thing I do is pick up my phone, and I'm always trying to network. I've been doing this for the last 5 or 6 years, and I do have a testimony to tell. So just remember that will be part of one of our next calls. So if they don't mind.
Just keep pushing. Keep pushing. You're doing great.
I can barely hear Mo.
no, you're
I said, keep pushing. You're doing great.
Yes,
You're doing
absolutely.
great. Keep that energy up. You're doing fantastic. And a lot of you all that's on our team now know Andre Turner. He's on our team now. He came through way of Benny. So everybody that was on Benny's team, you guys are all under our team now. Okay, so
Yes.
if you were Benny's team, you're on our team now. Okay, and I did not twist Benny's arm. I only twisted his toes. That was it.
It was worth it. It was worth it. I'm not complaining.
So anyway, Alicia, how's the leads going for you all? Where's Joseph? How Carolyn? How's the leads going for you?
I called the other two. I made got voicemails, left voice message. I did 2 calls on one call on the other. I'll follow up on the second one. The one that I did 2 calls on, I'm gonna follow up with an email since I'm not getting them.
Okay.
Can I input with that? So
Good.
I didn't mean to interject, but what I've done is, okay, so I sent you an email, the last set that you gave me. I did send you an email, and I always follow up and let you know what happened, what the outcome was. I made a call, did an email, followed up with a call. Out of those, I made contact with one person. They haven't did the scenario yet, so I'll do calls tomorrow. Also, one email was not great. So I used in the past a platform called Bouncify. It'll let you do up to like, I think 100 emails or so. It's free. All you got to do is recreate a new email, and it'll let you get back on there. So that's just a tip.
All right. Well, good. Share those tips with us. Keep it up. Keep it up.
Okay. I'm gonna be quiet now.
No, you're good. Go ahead, Marcus.
Oh, I'm sorry. I ain't mean to talk. Sorry about that.
No, that's okay. Okay. All right. So anyway, there's
Hey,
more
well,
leads coming.
Where is Joey? And the one time I do a presentation, Joey's not on. What the heck, man?
he got swamped today at the dealership, man. He was swamped today. So it's probably
Unacceptable.
So anyway, guys, thank you all for coming on the call. I know we went past the 9 o'clock hour. G, did you have anything else for everybody? Or
Nope. I had it wrapped up in about an hour, so it went well. I think we're good. I went over kind of what we're going to be doing on our calls, like, just a sneak peek on the Friday calls that we're going to, do the wellness program again in a few weeks, and we got your empowerment training and the don't be a Tommy call and all those things. So I'm good. If no one has any other questions, we can end it here. It's been recording the whole time, Mo, so we're good there.
excellent.
I just had some clarity. This
Yep.
product, the MCA, is not just for retail customers, but it's for any entity that has accounts receivable. Is that correct?
Correct. Yeah. It doesn't have to be retail. We do a lot of retail customers, but I got wholesale companies. I got funeral homes. I mean, you name it. There's a few restricted industries, but I pretty much can find a product for anyone that has receivables for the most part.
You said transportation was not one, so limousine companies is not an entity that can be utilized.
So we can go. There are lenders that will lend to transportation, but the regulations are high, right? They're they have to have multiple in transportation. They got to have multiple running trucks, and they might have to have much more higher qualifications. Transportation actually used to be the #1 fundable industry in the MCA space, and when the transportation industry took a major hit, a lot of the MCA lenders were seriously affected. They were really over leveraged in that industry. It even put a couple of banks out of business last year. So MCA trucking went from MCA's best industry to the worst in like a year.
I'm talking about specifically limousine companies.
Yeah, so for limousine, we can do it, but just expect that the regulations or the requirements might be higher. Again, I'll look at any deal, any industry, and I can tell you, hey, based on this guy's numbers, we can't, I don't know specifically what those are on limousine because I haven't done one of those in a while. But like recently I had a car dealership and they, in order to fund a car dealership, they had to have $1 million a month in receivables because it's a super high risk industry, which most big car dealerships are doing those numbers anyway. But it'd be something similar. I don't think it'd be $1 million, but it might be higher than a retail industry. So just keep that in mind.
Thank you.
No problem. I think any others? We good? All right. Well, I'm going to end the recording here.